The promise for today. By the end of this video, you know exactly what a candlestick is, how such a candlestick is formed, what information it gives us, and why being able to read them is a must-have skill for any trader. If this is the very first time that you're clicking on one of my videos, hey, welcome to the team. I'm Kata Trading and I'm documenting my journey as I become a volume price analysis trader myself, with one very simple mission. I want to give you all the tools so that you can easily implement this trading strategy so you can become financially independent for the rest of your life. And as always, don't believe anything I say, verify it. I highly invite you to be incredibly skeptical of anything or anyone, especially a stranger that you're watching on YouTube. In this chapter, we're going to answer one very simple question. Why is reading candlesticks an important skill to have? To answer this final question, we first have to answer 3 other questions where the answer of every single question better equips us to answer the subsequent question. The first question would then be, how is a price candlestick formed in the first place? Once we understand that, we have better tools to then ask the second question. What important information does a candlestick then tell us? And once we understand the important information that every single individual candlestick tells us, now we can answer the third question, which is, what is a candlestick? And once we answer these 3 questions, we're going to be able to answer the final question, which is what this whole chapter revolves around. Why is knowing how to read candlesticks an important skill to have? First, we need to cover some very important foundations. We have to understand that the market is a constant tug-of-war between 2 parties. Between 2 parties and 2 parties only. On the one hand, you have the buyers, which means that on the other hand, you have the sellers. Now, it turns out that sometimes you have more buyers than sellers, so the buyers are stronger. In other words, the rope is being pulled more to the left side, which means that the reverse is also true. Sometimes you have more sellers than buyers, and in this case, the rope gets pulled a little bit more to the right side. Now, when there is more buying than selling, we can also translate this to demand and supply terms. In this case, when there is more buyers than sellers, we have a situation where there's more demand than supply. And what happens when demand is higher than supply? Does the price go up or does the price go down? The price goes up, which means that the reverse is true. When there is more selling than buying, that means that there is more supply than demand, which, surprise, surprise, what happens to the price then? If it doesn't go up, it goes down. So these constant fight between sometimes being more buyers than sellers and sometimes being more sellers than buyers is what results in an imbalance of supply and demand. And this is what we call the supply and demand law. And this is where supply and demand is what ends up forming the price candlesticks. Now let me read that one more time. Supply and demand is the thing that ends up forming the price candlesticks. Okay, cool. That's an interesting statement. But Caro, how is that even possible? Can you please explain that? I'm happy you asked. How is a price candlestick formed through supply and demand? And to make sure that we're all on the same page, I want to make sure that we're all visualizing the same thing. Whenever we say candlesticks, this is the thing that we're visualizing, which is what you're going to see in any chart that you're going to open. It's these rectangle bars that you see in the middle of the chart. To answer the question how supply and demand ends up creating one of these candlesticks, we're going to look at one candlestick in isolation. Specifically, we're going to look at this cross-looking candlestick where the stick to the upside is longer than the stick to the downside. And in order to dissect it, so to explain to you how this very specific candlestick was formed, I'm going to walk you through a hypothetical scenario where I want you to envision that you're going to go to the food market on a Monday and you want to buy an apple during the day. This is the food market example. We're going to look at the price of an apple on a Monday, where on the y-axis you have the price in dollars for one individual apple, and on the x-axis we have the time in hours, starting from 9 in the morning when the food market regularly opens, all the way up until 4 in the afternoon, which is when the food market regularly closes. Let's go through the story. Let's say, hypothetically speaking, that at 9 in the morning the price per apple is $3 per apple. Now we know that at 9 in the morning is when the food market opens. There's not many people buying, so the price is going to be low. But at around 10 in the morning, let's see what happens when more people start going to the food market. The price ends up going from $3 per apple to $6 per apple. Now, what happened here is an instance where demand is significantly larger than supply, causing the price to go up. Again, any moment that the price either goes up or down is due to demand winning over supply or supply winning over demand. When 11 a.m. rolls around, the price of an apple increases with $1 or more. So the rule still holds that demand is larger than supply, causing the price to go up. Check. Now let's see what happens at 12 p.m. Same thing, same story. Price goes up because demand is higher than supply. What happens at 1 p.m.? Exactly the same thing. But now the price went up with $2 per apple. But in essence, demand is still significantly larger than supply, causing the price increase. Now here's the interesting thing. When 2 p.m. rolls around, take a look at what happens to the price. It decreases. It goes from $10 per apple to $8 per apple. So instead of having demand being higher than supply causing the price to go up, we've got the inverse situation where supply is higher than demand causing the price to go down. When 3 p.m. rolls around, same story. Supply is higher than demand causing the price to go down. And at the very end, the price goes up from $1 per apple to $4 per apple. And the price went up now not because supply was higher than demand, but because demand was higher than supply. Cool, we have a beautiful line chart. How does this translate to a candlestick? Like, I still don't see the candlestick, Caro. We're gonna get there. Let's take a look at this line chart that we just drew together, which is a result of the continuous imbalances between supply and demand. And we're gonna do something special. We're gonna do something interesting. Let's draw a horizontal line at the opening price. So all the way from the $3 per apple, we're gonna draw a horizontal line, and we're gonna label that the opening price. Now we're gonna do the same thing for the closing price. The closing price wasn't $3, but it was $4. And we're gonna do the exact same thing for the highest price during the day, which was at what time? It was at 1 p.m. And we're gonna repeat the process by drawing yet another horizontal line at the lowest price point during the day, which was at 3 p.m., which was a price of $1 per apple. Here's when things get interesting. We are going to cover the distance between the opening and the closing price, and we're gonna fill it in, which looks like this. It's gonna give us a rectangle. The next thing that I want you to do is we're gonna draw a vertical line that connects the highest horizontal line with the lowest horizontal line, which looks as follows. And this is the candlestick that you saw on the chart. Do we now see how differences and imbalances in supply and demand lead to the price fluctuations? And from those price fluctuations, you then end up drawing a candlestick. Every single individual candlestick is printed through these methods. That's it. Supply and demand define the shape of a candlestick. Of course, every single part of the candlestick has a special name. The vertical line that goes on top of the rectangle is something that we call the upper wick, which means that the reverse is true. The vertical line that goes below the rectangle, it's not the upper wick, but it's the lower wick. And the rectangle that is filled in also has a special name. Actually, 3 different names. You have the body, the range, or the spread. It's like different nicknames, like you can call me Carolina, Carito, or Caro. And this, ladies and gentlemen, is how every single candlestick is formed. It is the imbalances in supply and demand that cause the price to either go up or down depending on who's winning. When demand is higher than supply, prices go up, which is exactly what happened in this part of the chart that I circled in orange. This is when the buyers are winning and the sellers are losing the battle, which means that the reverse is also true. When supply is higher than demand, the prices go down, which is what you see in the orange part of the chart, which means that instead of buyers winning the battle, it's sellers winning the battle at the moment. Sellers are winning. So now that we answered the question, how is a candlestick formed? Now we are better equipped to answer the second question. What important information does a candlestick then tell us? And in order to answer this question, I'm going to walk you through a story that the candlestick that we just looked at actually tells us. This is the candlestick, and the story goes like this. After the market opened, buyers stepped in and overpowered the sellers, causing the price to go up. You see on the top right, I have price goes up when demand is higher than supply. At some point, the buyers stopped winning the battle, so the buyers ran out of steam and the sellers stepped in, overpowering the buyers, causing the price to drop. So there was a switch in the imbalance where first demand was winning, but now supply is winning, causing the price to go down. And the candle is still printing, by the way. And right before the session closed, buyers then ended up overpowering the sellers again, and they won the session ever so slightly, which is why the candle closed green. And when I say that the buyers won the session ever so slightly, I mean that at the end of the day, the buyers were able to push the price higher up to the point where the closing price was slightly higher than the opening price. Now, whenever a candlestick closes green, this also has a special name, which is called bullish. So a green candle is a bullish candlestick. Got it. And by definition, it's when the closing price is higher than the opening price. But what happens when the closing price is lower than the opening price? So what happens when the open and the close reverse? You know, like an Uno reverse card. Let's take a look at that. This is the green candlestick that we had. And in the next slide, I'm gonna draw the exact same candlestick with the only difference that the opening and the closing price are switched up. Pay attention. Look at that. So now let's take a look at the story that this candlestick then tells us. It's the same candlestick, but instead of it being green, it's red. After the market opened, the buyer stepped in and overpowered the sellers, causing the price to go up. Again, price goes up because demand is higher than supply. Got it. At some point, the buyers ran out of steam and the sellers stepped in, overpowering the buyers, causing the price to drop. Supply is higher than demand, causing the price to drop. Check. Now, so far, the story is the same as the green candlestick that we just analyzed. And here's where the difference comes. Right before the session closed, the buyers overpowered the sellers again, but not enough to win this session. So the sellers won this session, not the buyers. Like the buyers were stepping in, they were pushing the price up, but they were not able to push the price higher so that the candle closed higher than it opened. It closed below where it opened. And that's why we say that the sellers won the session. And this is why the candle closes red. If a green candle is called bullish, a red candle also has a special name, which we call bearish. A bullish candlestick is when the closing is higher than the opening price, bullish. And a bearish candlestick is when the closing is lower than the opening price, bearish. This means that the shape of the candlestick is the result of the constant tug-of-war that is happening between the two parties. Call them however you want to call it. The fight between buyers and sellers, the fight between demand and supply, the tug-of-war between bulls and bears. And it tells us who tried to take over at what price points and who ended up winning and by how much. And this is the very important information that candlesticks tell us, which means that we have answered the second question, which also means that we are now better equipped to jump to the third question, which is, then what is a candlestick? A price candlestick is nothing more than a visual piece of information that shows us who is taking over at specific price points. Bears or bulls, sellers or buyers, supply or demand, and who won the battle and by how much. And that's what a candlestick is. So now that we have answered these three questions, you guessed it, we're now equipped to answer the one and final question, which is what this whole chapter is about. Why is knowing how to read candlesticks an important skill to have? And again, the best way to answer this question is by showing you other examples on how to read candlesticks so that you can see the importance through your own eyes. Basic candlestick examples. Candlestick story number 1. This is a random chart that I took, and we're gonna focus on this red rectangle candlestick right here. And the story goes as follows. After the market opened, which is where you have the horizontal open line, the sellers stepped in and overpowered the buyers, causing the price to drop, which means that supply is higher than demand because that's the thing that causes the price to go down. Now, at no point were the buyers able to overpower the sellers to bring the price back up even a little. Now, what do I mean by this? Because right now we're at the bottom of the rectangle of this candlestick. And if the buyers would have been able to step in, that means that this red rectangle would have shortened a little bit, creating the famous lower wick. But that never happened, which means that demand was not higher than supply. And this leads us to the following conclusion. The lack of lower wick tells us that sellers were consistently winning. And in other words, there was strong bearish sentiment. Remember, red equals bears equals the animal bear. So whenever you see a rectangle that is fully filled in, that means that there was strong sentiment in that direction. In this case, strong seller sentiment or supply sentiment or bear sentiment. You know, I invite you to use any concept that best fits your mental frame. Now let's take a look at the second story of a candlestick. And now we're going to focus on the reverse. We're going to focus on this green rectangle candlestick. The story goes like this. After the market opened, the buyer stepped in and overpowered the sellers, causing the price to increase. So we have an instance where demand is higher than supply. Now, at no point were the sellers able to overpower the buyers to bring the price back down. And I say this because if the sellers were able to step in, then that means that the green rectangle would have been compressed on the upside, and the rectangle would have become less white, creating the famous upper wick. So that means that supply was never higher than demand, and therefore we can conclude the following. The lack of upper wick tells us that buyers were consistently winning. In other words, there was strong bullish sentiment. Green equals buyers equals bulls. So whenever you have a green rectangle candlestick that is completely filled in, it's completely green, you can conclude, okay, there was strong sentiment in the upwards direction, a bullish sentiment. Now let's take a look at a third example. And in this case, I want to focus on this cross-looking candlestick. Let's look at the story. After the market opened, the buyer stepped in and overpowered the sellers, causing the price to go up. Demand is higher than supply. Then the seller stepped in, overpowering the buyers, causing the price to drop. You guessed it, supply became higher than demand, causing the price to drop. But then the buyer stepped in again and overpowered the sellers, causing the price to go up again. And by the end of the session, the bulls won only by very little. And we know that the bulls won only by very little because the candle is green. Which means that when there is no clear body range or a clear white rectangle, there is no clear sentiment in one direction. Because when we had the red rectangle, there was strong bearish sentiment, clearly in one direction. Which means that when we have a green candlestick that is completely filled in, there is a strong sentiment in one direction, in the directions of the bulls, which means that whenever we have a cross-looking candlestick or when the body is very narrow, we don't really have a clear winner. And that's why we say that there is no clear sentiment in either direction. So there is indecision. The bulls are pulling, the bears are pulling, the buyers are pulling, the sellers are pulling, demand is pulling, supply is pulling, but the rope at the end of the day, after going right and left, stayed pretty much centered. And that's how you get these cross-looking candlesticks. I want to say something important, and that is one candlestick can have different ways in which it was formed. Now, what do I mean by that? The situation that we had is a situation where after the market opened, first the buyer stepped in, causing the price to go up, then the seller stepped in, causing the price to go down, and then the buyer stepped in, causing the price to go up again, closing higher than the opening. But we can also have the reverse scenario. And the story goes like this. After the market opened, sellers step in first, overpowering the buyers and causing the price to drop. Supply is higher than demand. Then the buyer stepped in and overpowered the sellers, causing the price to go up. Demand is higher than supply. Then the seller stepped in again, overpowering the buyers, causing the price to drop again, slightly above the opening price. So this candle closed slightly above the opening price, also ended up being green. So by the end of the session, once again, the bulls won only by very little. There's no clear sentiment in one direction because it's not clearly the red candlestick with a white body. It's not clearly the green candlestick with a white green body. In other words, there is indecision. It's a tie in the tug-of-war. Notice how we had first buyers, then sellers, then buyers, causing this green cross-looking candlestick. But now we have first sellers, then buyers, and then sellers, causing the same green candlestick. And this is what I mean when I said that one candlestick can have different ways in which it was printed, in which it was formed. And this is why it's very important to use multiple time frames to be able to open up a candlestick, to dissect it, to be able to see how did the price move inside of it. Did the sellers first step in and then the buyers? Or did the buyers first step in and then the sellers stepped in very last minute? And these are skills that we're going to learn in later chapters because this chapter is specifically focused on understanding how to read candlesticks at the most basic level, specifically understanding why is it so important to have this skill. And now, full circle, guys. Why is knowing how to read candlesticks an important skill to have? Each candlestick shows the end result of the supply and demand imbalance that happened while it was forming. This is how the candlesticks are formed. And every candlestick tells us who is winning at the moment. Is it the bulls that are winning? Is it the bears that are winning? By how much? And whether there is strong market sentiment in one direction, remember the very white rectangles, or indecision, remember the cross-looking candlestick. This is the important information that the candlestick tells us. And this visual representation of the battle, which is what a candlestick is, a visual representation of the tug-of-war that is happening, shows us what has happened. So that with the help of other indicators like volume and whichever indicator you want to support your trading strategy, we can make a well-informed decision about what is likely to happen next. For example, let's say that we have a chart and we constantly see the buyers stepping in when the price reaches a level of $10 per share. So the price is going down, reaches the level of $10 per share, and then the buyers step in. And then again it happens, the price goes down, the buyers step in, causing the price to go up again. It is then very likely that in the future, if the price, after going all the way up to $50, $60, ever returns to that $10 price per share, that the buyers are going to step in again, supporting the price. And we can conclude this by looking at the candlesticks and at the shape of the candlesticks. Now, of course, this is just one part of the story because sometimes candlesticks can be legit or fake. I'm gonna explain that later on because that's when volume comes in. But for now, candlesticks in general, they tell you a huge part of the story, not the whole story, but a huge part of the story of what is likely to happen next, which is everything that we want to do as traders. And this is why it's important to know how to read them. Correctly interpreting candlesticks allows you to recognize patterns in advance so you can act upon them. And this is why I wanted to dedicate a full chapter to this, because it's so important that when you look at a chart, you don't just look at colors and draw random lines and say, I'm gonna buy or I'm gonna sell if this line gets crossed. No, there is a story behind it. Like there's information that we need to decode through candlestick reading. So now we answered the final question. Congratulations! Because we learned how candlesticks are formed and now have a basic understanding of the powerful story they tell. Now to clarify, this is highly simplified. There are way more nuances to it, but the goal of this video is I wanted to teach you guys how I wish someone would have taught me. It's the way that I explained this concept to my boyfriend, which is one of the very first videos that I uploaded on YouTube. And then teaching him, I realized, wait, I wish someone would have taught me like this. And that's exactly what I'm teaching you. And this is it for today's chapter. But what about next session? In the next session, we're gonna go more in depth on how to read different types of candlesticks. We're gonna zoom in on what their shapes and sizes tell us. And more specifically, we're gonna talk about what's the story that they're telling us, because as we just saw, there is a story that we need to decode. We're also gonna be looking at more real life chart examples because I want to make this as applicable as possible. I really wanna make the theory stick. And we're also gonna look at some candlesticks together, because in this chapter, we looked at candlesticks in isolation, but it turns out that you can also look at candlesticks together, so two candlesticks, and analyze them as a group. This is what people call candlestick patterns. And my only goal is to give you something actionable right away, because one thing is the theory that you're assembling right now, like the theory that you're accumulating, but the real wisdom comes from applying it, making mistakes, and learning from those mistakes. And I want to bridge that gap as easy as possible for you. I really hope that through this very simplified candlestick explanation, I was able to deliver some value to you. I want to be of service to you. I want to make your learning curve as easy as possible. So if I was able to do that with this video, even by a tiny percentage, I'm very happy with that. So thank you so much for your time. And remember, enjoy the process. Unless you've got other plans.